Hey, fellow traders. Hey, all the new subscribers, new viewers, and returning viewers. Welcome to the channel. If you haven't already subscribed, make sure you do so now and hit that bell for the notifications for all the new videos coming up, as well as the live streams that I'm going to be doing here pretty soon. Getting a new setup going here so that I can make some better live streams, and still working on a few different things. And I've got a lesson planned for the next talking points on the next one. For right now, I've got a video for everybody. This one's basically 4 simple price setups. These are price setups that I've seen work and use quite consistently and quite continuously throughout most of my trading, even on my short term, long term. Looking at mainly these setups specifically because they do tend to have a high probability of working out. So we're going to start out with the basics first and then move on to a little bit more advanced towards the end. The last 2 are going to be the primary 2 that I'm always using. So let's go ahead and take a look at the first one. Now, I did try to record this before and I made a boo-boo. I wound up messing up the record. So some of these drawings are a little bit made already, but I'll go through everything again. But starting with the first one, it's the basic continuation break, or it's also a line break. And you're going to be looking for this type of setup most commonly as you come into a 1 hour time frame chart. You're going to look, or even a 4 hour time frame chart. The first thing you're going to start looking for is a consolidation in the higher time frame. And as long as you have that and you're starting to make a move out of that consolidation, that's when you're going to start looking for this type of setup right here, where basically price has made a strong move down and then it's going to start consolidating up. And as it consolidates up, you're going to basically plot a trend line or mark a trend line out. And then as soon as price goes and breaks that consolidation zone and breaks that trend line, as soon as you have a candle that closes below there, you're going to take a short entry. And this is not to scale because of the drawing part, but you're going to be looking to get between a 5 to 7 pip stop loss usually in a situation like this. If it's during the New York session or a high volume session, you may be looking at about a 10 to 15 stop for this type 10 to 15 pips stop for this type of situation. But it's going to give you a very low risk, high probability entry, and then you'll be able to actually trail into break even rather quickly. So like for example, if the price was making this type of formation here, once you break this low from this high, then you could probably go ahead and move your stop loss to just above this high. If there are any wicks, you want to make sure you're covering those. Even if there are some wicks up, possibly, you'll want to make sure that your entry is covering those wicks. And then as price continues to move down, every time you break that low, you can move your stop. So in this case, it would go there and then there. And depending on how long you've been holding the trade, where your potential outlook is in the market, you may want to consider taking a target. But very oftentimes you can see this produce some pretty long trades with trends continuing, especially when you have that high pressure dropout after a long consolidation on a higher time frame. So as soon as you're starting to see consolidation on a higher time frame, that's usually your key to start watching for either a long or a short. Now, if you're going long, it's going to pretty much look the same way. Price is going to push up. It's going to slowly kind of consolidate back, and then it's going to push up again. Now, every now and then, you may have some type of support level or something like that where price will reject from and get support from. But occasionally this may not be the case. You may not have anything nearby to use. So all you would need to do is, once you spot that consolidation, is draw that top side trend line And then once it has the break, you have the candle close, and it confirms closed past and above that trend line. That's when you would look to go long in this situation. So if you had your close there, then you could cover your wicks, cover your low, and as price continued, as soon as you broke this high here, started to come back and make another new press of a new high, then you just move your stop loss. So let's pull our stop loss from that trade, and we would put it there. So it wouldn't take very long to start to get some type of positive gain using this type of setup. If you can find this in the higher time frame, just zoom down into your 15 or your 5-minute time frame and start to look for this type of pattern here. Now, I would not really try to look much deeper than the 5. A lot of times you can get false trends and false signals out of a 1 minute because price may push up, close a couple of times for a minute or two, and then suddenly plummet back down. And then on your higher time frame, that ended up being a wick. So something to look out for if you're starting to zoom really close in on price. But this entry does work on all time frames, so if you're looking to go really low with it, you could probably find some success with this, especially in trading in this little area here. If you zoomed into the 5 or the 1 minute, you may find some useful setups, although they will produce some very short and small gains, such in the case of this one, you may get 8 or 9 pips out of it. So just keep that in mind. The lower the time frame, the smaller the scale of the trade you'll be making. But that's going to wrap up the first one. This one's pretty simple. If you come back and break the low, oftentimes it'll be making a double top or a lower low, or just barely break the high and come back. So those are a couple of signs. If it does do any one of those couple of things and then come back and close below the low, it's very likely you might not have a valid trade in that position, and you may want to close out early if you're already holding. Now, the second type of entry, this is the one I kind of first used primarily when I was in my early days of trading, but you'll find this one especially on the shorter time frames, real common on the 5 or the 1 minute. You'll find a lot of these setups. It will also occasionally happen on the hourly, although you won't get near as many entries or setups. This one's a little bit more rare and is a little bit tricky to spot. But basically what you're looking for is you had like price pushed up and is starting to continue to make maybe a long uptrend. It's been continuing for a while. This may be over the course of a few days or so, but it's basically just making a long trend. And then what's going to happen, or in the case of the shorter time frame, it may be doing this for a couple of hours or so, where it's just making higher highs and higher lows. You could be doing this most of the day, and then suddenly you'll spot a break of a trend line. Now, this could be a continuation from a higher time frame, but if you don't have that kind of move, this could be a potential sign that this is the top. So what you're going to do is you're going to wait for price to retrace, and oftentimes you're going to keep an eye out on the lowest low. So let me get this out of the way and clean it up so we can have a clear picture of what we're looking at. So you would mark out this low, and of course once you get a candle close below this area here, that's when you're going to start looking for either a possible entry here for a short off of this lower low. You can be in this area here. Just make sure that you're covering your highs. But very oftentimes you'll see where you would get a much better entry by just holding out until, especially if you're getting another candle close back up, to wait until price gets very near the underside of this uptrend line, the same for a downtrend. And this is where you oftentimes get those very shallow angle tops. This entry will line up. Also, There's another type of setup of this. I'll show in just a second, but this is going to actually give you a much better risk reward ratio if you see kind of a long trend that's not too sharp. Uh, you'll oftentimes find a much better risk ratio by going and waiting for the divergence, or you could just keep a shallow closeout point and just stop your trade if it breaks this high and wait for the entry here. Then you could save that distance between the two as loss and get a better entry as well. You could also wait for a strong rejection to jump back in. It won't give you as good of a ratio, but still much better than uh, waiting on something along the lines of this. Significantly better for your risk ratios. Now, the second variation of this is if you have a really sharp uptrend. A lot of times you'll find this off of a little bit further back in the price action. You may find this in a consolidation range. And oftentimes you'll find this near the top where there's a very likely possibility of a lot of liquidity in this area. So you may see price kind of break that trend line like we were talking about earlier, and may come up and start to kind of fight a little bit, break through this high and continue pushing up. It may take a second to get there, but then suddenly it'll push up really strong. And very often you'll see the wick of that candle touch right on the bottom of this line. And this line is often made with closes. I usually talk about this in a couple of videos, but I usually use my closing points for everything that I'm looking at, except for a few different occasions. So just draw the trend line off of the close and opens of the candles. That looks the most common of a trend line. And then oftentimes you'll see price wick into that line or get very near it. And that is where you're going to find your best probable entry in that situation. It could also be a possibility to consider lining up if you were kind of looking to get in a little bit earlier. Again, like say you were getting the rejection there, but then you see that trend line after you enter, you may want to account for your stop to take some time to allow price to reach up there and come back, because you may get wicked out, or you may try to opt for the uh, additional method of risking 1% but closing out at 1.5% and going with a little bit wider stop using that type of strategy. So that could protect you in getting wicked out there, but oftentimes your best entry is to, if you go short there and it breaks, close out, just like in the earlier situation, then grab your entry either off rejection or somewhere near the line and take a much higher reward ratio and save that risk in the middle. But those are the two different variations of the divergence type setup. And now we're going to get into my most heavily used setup, my favorite setup. This is one I've kind of been studying for a while, and here as of late, since I developed the 15-minute simple step strategy out of it, I've kind of been studying a little bit deeper, and this is actually by far one of the best setups to use. There's a few different details to it. It's not quite as cut and dry as the other two, and it does help if you know the other two and see some of that happening along with this to kind of confirm. So this is getting a little bit more advanced, but this is a very strong pattern that'll give you extremely low risk and high probability entries. You just have to be careful at which ones you choose. I honestly recommend with this type of setup, never ever really trust much below the 5-minute, and your strongest signal is going to be on your 15. You could also find this on the 30-minute, the hourly, the 4-hour, so on and so forth. All of your time frames, you will see this. Just keep in mind that the higher the time frame, the less likely you're going, or the less the abundance of entries will be. So let's go ahead and start taking a look at the details of this one. And I'll clean this. Oh, well, I can leave that there. That'll be fine. It's not really going to be in the way. But basically, for this right here, you're just looking for, just like the name says, you're going to have like a consolidation area, and let's assume we don't see this just yet. You're going to see a consolidation area. and you're just going to draw a simple box around it and past it. Oftentimes you can have the option to extend the box to the right, but eventually you're just going to have boxes all in the way and you're not going to be sure which one to keep up with. So you may just want to draw it just a little bit past, because very often what's going to happen is it's just a simple break and retest pattern. But there are a few details to it to help you be a little bit more accurate and on point with this pattern. So it can give you, like I say, really tight risk reward ratios. If you're using tight stops or whichever method you choose, it's going to definitely keep your risk down overall. But in a nutshell, what's going to happen is that price is going to consolidate. It's basically just a cluster or a tight group of price. It's going to happen over either a short or even long period of time, but usually will cover the course of at least 15 minutes in the strongest cases. But you'll just draw a box basically around the closes, but mind the wicks. The wicks are for our entry. The box is actually for the setup. So what's going to happen is you're either going to have some type of event if you're looking at discretionary, but you're basically going to have some type of imbalance happen to where we push out of this range. We may break or we may come close. We're definitely going to break the wicks on either side of which way we go. So if this is a long wick, just look for this push to close at least outside of the close of these boxes, but you're going to want to make that move past that wick at least, or the lowest point of this area. That'll kind of give you a strong indication that price is going to continue that way. If it comes close to it or doesn't quite pass it, it's possible it's a fake and it could reverse. So that's the first little detail. So we want that to push past the lowest point first. Okay, so this is number one. And then number two, price will come back and immediately retest, and will usually line up right on the closing area of the bottom of this zone. That is where you're going to find your short entry to be the best. If you have a little bit of a spread, you may want to go a little bit below. And then you're going to want to make sure your stop or your closeout point is going to be above the wicks, but we're going to go into a little bit more detail here in just a second. But if this entry here does not work out to where it comes pinpoint close right on this range, we'll go ahead and look at another example. Let's see, I think I had that area marked out. So price will basically come up, retest, break past this low to show continuation. So that is a very strong sign that it's going to continue at least for a little bit. And then you're going to basically see this pattern start to repeat. Every time it comes back to retest, it will oftentimes end up retesting the same way. It's going to end up retesting right on the level, right at this zone, right in this little area. That'll be another entry. If you missed this entry here, or if you're looking to compound, that would be a safe entry. And then just cover any wicks from this zone. So like say that was a wick sticking out there. So then your trailing stop, if you were using one, could go to there. I would definitely wait though until you get the rejection and clear of this low to try to trail down, unless you're being extremely aggressive or trying to just go break even as quick as possible. This one is not so much a break even quickly type setup. It can sometimes tend to take a minute to get to break even. So you want to make sure you're using a little bit of outside looking in kind of relation to determine your signal. But once you get a signal, everything is dependent on what just previously happened before the next point we get there. So that is one detail to keep in mind. So now to come to the invalidation point. So we have 1, 2, 3, we clear the low. 3 is clearing the low. And then what's going to happen next is you're just going to continue seeing this same thing happen, continuing down. And this is where you get the idea of steps. And now we're going to come to the invalidation part. And this is where this previous setup is no good. And basically, occasionally, price will retrace, come to the middle zone, and then reject and continue. But in case of invalidation, you will have actually a candle close. You will have it come up and close above that midpoint of that little price consolidation range. So we're using closes of everything, and the close above the halfway point gives you about a 90% probability of invalidation. And oftentimes in this situation, you're going to see price. I set it up a little bit different. Sorry about that. Let's go ahead and continue from here. Basically, price will continue up, and it will usually carry on just past this last area, or at least past this zone here. So oftentimes you'll commonly see it break up just past, retest the top of this zone. It may even make another zone, or it will come back down to a zone that we have here in order to do a reversal. But usually once this previous pattern is broken that way, you can usually find another one of these price consolidations and look for a retest off the top and go again. Very oftentimes this will set up to go for a strong reversal. I've seen this happen often, and this is the number one reason why they say avoid trading the steps, because you may catch this very nice entry here, not get very much distance out of it in some cases, and then get an eruption of price right into your stop. So as long as you're being mindful of this setup, as soon as you see this invalidation, you can either immediately close out there at that point. You can close out once you get that closing candle above the invalidation point, or you could wait to see if it's going to retrace into this area and close it out there. But this midpoint here of that last zone makes that entry from here. So if you had a short and you were using a larger stop, for example, and say you had tried to go here and go short, so you're covering your lows, you have that close here, you may want to choose to go ahead and close out there, because at that point it's very likely that we are about to invalidate and go the other way. So something to keep in mind when trading that, but that is the invalidation of this signal. And keep in mind as well, it has to be a close, not a wick. If the wick goes past it, but the actual close of that candle does not cross and close above, that is still a valid setup. That is still good and still very likely to carry on. It's just stalling for a minute. Something's going on in the market. There's a drop of liquidity, drop of demand, supply, whichever direction you're going. So that does not invalidate, but that does. So just keep that in mind when you're trading that pattern. So that would be a no-go. So just a little example of what you might see in a reversal going through. That's our pattern to begin. You get your wicks outside, you take your entry short, stop above, and then trail down, and then you may be trailing or above this area here. Now once you see price come back here, you'll want to go ahead and close out here, and that's when you could then start to look for buys, and just repeat that pattern going up. Take your stop. Every time it breaks, you would cover the lows, or even cover the previous low if you're using a tighter stop. And then as price continues up, each time it breaks, just carry your stop up. You could even go with that area there or stay below the area. Just keep in mind It's possible that you could get a pin below the area and a close above. So you may want to be cautious about moving up too heavily with your stop using this method. But if you do see typically a strong move, it could go either way, either with a strong eruption or it could snap back. So just something to keep in mind. You may want to consider if you're seeing a really hard push and a change in the pattern and volatility. Just be very cautious with that because you may get that rubber band price action to come off of another setup that we're about to go and look at. And this is basically the inside out version of that cluster pattern. And this is going to be the fourth setup. It's going to be basically a doji setup, but this is a very special doji. You're not looking for just any ordinary doji. You are looking for a cooperative tool, preferably, and then basically what you're looking for is you're looking for a very strong up push in the price. It could be a wick, it could be a long wick, short wick, makes no real difference whatsoever. It just has to be a strong push of the market, and then suddenly you see a doji. Again, this is going to be one of those patterns that are much more suited to a 15-minute or higher time frame. These are really strong off the hourly if you can find them. And what makes this doji special is the actual open and close price. That in itself will tell you when you have this type of setup that there are usually a heavy amount of orders right here at this very price level. You may get some wicks past it, but you are most definitely going to get strong reactions out of this level. And the reason being is when you have a strong move up like that, it takes a equally stronger pushback to stop that move suddenly. So when you see that type of pattern, that type of setup, you know there are loads of orders right inside this doji. And to kind of zoom this out and kind of show you what this looks like in action, say you see this type of pattern, just imagine this over here. And basically what's going to start happening at this point is you're going to notice price is going to kind of slowly retrace a little bit. It may consolidate, dip down, and then it will start to push back up. It'll slowly come back up again, maybe even make that other little step pattern, and this is what you'll have to kind of look out for. So this is carrying out of that previous example. It goes slow. You may get a little bit of a reaction here, but most oftentimes your best entry is going to be right here in the middle, right in line with that open close of that doji, because you will then be riding right alongside the larger institutions, the big order. Basically, you're going to be right in line with the big order that stopped this big move. And very often you will see this happen where you catch that entry here. Again, same idea. You just want to cover your highs, cover your wicks. So in this example here, we'll get this a little bit more proportional to the drawing. Just know the numbers are not quite to scale just because of the way I drew it out. But you would basically cover your wick. I can even transfer this over like this. There we go. So then you would cover your wick and wait for rejection. And very often you'll get a very strong rejection. It'll come up and then make a strong push down. Occasionally you can have a wick or oftentimes a retracement back into this level. It could tend to sometimes go and push down a little bit, kind of test up, maybe wick a little bit, wick a couple of times, come back down a little bit, wick one more time, and then drop. So you're going to see this happen a couple of different ways, but if same rules apply as the last pattern, if you do get an actual close of a candle that just happens to come up and close above that midpoint, it then drastically reduces the probability that this will be successful. But you also got to keep in mind there are some major players involved in making this doji. So they could allow price to run a little bit, try to make a liquidity run up above, and just take out people that are trying to play this pattern. So sometimes, more often than not, you're going to come out a little bit better by looking at a little bit wider stop, because then in this case, this is also a very good example and very good way of uh, having a high probability of, say, for example, it starts to drop again, pushes up, takes out liquidity, goes, but then all of a sudden now this little group of price action takes over as that little setup. More buyers come in, that now becomes support and comes out. This would then be a good entry point if you see some stalling or see some respect. We don't get a close here. You may want to close out and take that small loss and not risk getting taken out in liquidity. So you would be, looking at a significantly smaller closeout loss. So that would be one good way to trade that probable pattern. You won't find as many of these, but if you are near the top of a longer trend from a higher time frame and you see this type of pattern here, it is very likely that that is going to be the top, and you will wind up having some sort of trend line, and price will continue to go down and make your double tops with your shallow tops. So that's oftentimes where you're going to see that price set up and that type of setup work out. And very often it does work out to where, worst case, it may grab a little bit past that, but ultimately just drop out. And the same goes for bottoms as well. You'll often see this made with double and triple bottoms. Usually a doji, after the big move, immediately after stopping that move, will usually be somewhere around the bottom of that double bottom in that case example as well. So just keep in mind, though, always look to 15-minute or higher for your signals. And these last two that I showed you are much more reliable when combined with either the line break or the mechanical divergence. There are a few exceptions, though. You'll have to kind of study and get experience. You can't really determine how price is going to set up every single time, so just study the chart, look everything over, and get a little bit of practice with it. I've been using the last two setups. Actually, now I moved from discovery to testing to forward testing to now I'm live using it quite well. So I'm actually quite confident in that setup and making these last two that we talked about my primary setup. And I think that's going to do it for this video. I'm going to prepare a little bit further, get the setup done for the live stream to make sure I get a little bit better video out this time. But for now, that's going to wrap things up. If you haven't already, make sure you subscribe and hit the bell and leave a thumbs up on the video if you got some value out of it. I'll see you on the next one. Hopefully I'll catch you on the live stream. Just, if you have any questions now, drop them below. If not, save them for the live stream and I'll try to answer them. I'll be doing either practice sessions or live trading, or even considering doing some live lessons. So as I'm teaching, you guys can ask questions and I can go a little bit deeper in detail of what I'm talking about. But let me know what you guys think below, and I'll see you on the next one.